Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Portillo's Inc. today. Recently started a position in Portillo's. This is not investment advice, but wanted to do a video on this. Taking a look at these guys quite late because I bought this about 2.5 weeks ago, but then I went on vacation to Arizona. Sedona's very pretty and haven't had time to do any videos, so welcome back to the channel. Portillo's, as you can see, is a restaurant that serves quite unhealthy food, which is kind of not in vogue these days as companies like Cava, Chipotle, and even Shake Shack have kind of moved the food into the healthier space, however you consider healthy. These guys kind of don't do that. They sell Italian beef sandwiches, hot dogs, cheeseburgers, cakes, and desserts. You can kind of see their sales makeup here, but also they sell salads. 8% of their sales is salads. Very good, very good. They've been around since 1963, but really they haven't started growing outside of the Chicago area until 2014, where they were bought out by a private equity company. And that's never really a good sign for me when a private equity owned company IPOs or goes public via SPAC or whatever, as they did in 2021, because they always structure it in a terrible way. And that is the case here. So we'll talk about what that means in a second. But again, companies growing at a pretty good clip. The average unit volumes here are amazing. 9.1 million in 2023, already net income positive, operating income positive, adjusted EBITDA is solid, restaurant level margin is really good, and just really solid numbers on paper, and a lot of potential for growth. You can kind of see how their sales go out. Drive-through makes up 40% of their sales, and that's 2 times the throughput of a typical McDonald's in 2023. Their dine-in and carry-out is 4.2 million. That's more than Chipotle's total average unit volume per restaurant. And then their delivery is 1.2 million, which is more than Domino's average delivery volume. Really solid numbers, and that's kind of the story here. They make a ton of money per restaurant, mainly because their restaurants are huge. We'll talk about that in a second, but they have a lot of potential for growth, and that's kind of the key here. The key driver of future Portillo's valuation, a lot of these things are from their own investor presentations or earnings releases, is new unit growth. They're going to try to drive accelerating profitability in terms of unit growth through developmental discipline. They're going to revamp the way they choose their markets and site selection. They've kind of talked about what makes a successful site in Chicago versus what makes a successful site outside of Chicago. They're de-risking their restaurant openings with better unit economics, and they're kind of improving their overall footprint availability because of that. And you can kind of see their history here. Founded in 1963, slow growth into 2000s. Then once they get acquired by the private equity company Berkshire Partners, again, no relation to Berkshire Hathaway at all, started to grow, started to take on debt, IPO'd in 2021, and now they're growing faster with a long-term growth target of 10% plus. You can kind of see where they are and where they're going to be. Started out in the Illinois area, spilled out outside of that. Now they're moving into the Sun Belt, and Illinois still a huge part of their business. 48 of their 84 restaurants are in Illinois, some outside of Illinois, and then moving into the Sun Belt now, and 2 in California. So plenty of growth potential here if you kind of consider, where are they? Where could they be? Or they could be in all 50 states. They're really in like maybe 9 or 10 states now, and mainly in the Chicagoland area. And you can kind of see their restaurant level economics here compared to players like Cava, Chipotle, Shake Shack, Sweet Green. Again, those guys are doing 3 to 4 million in average unit volume with margins in the 15 to 25% range. On average, Portillo's is doing 8.8 million average unit volume with margins in the 27% range. But a lot of that is driven by the successes of the Chicagoland area. You can kind of see that. Chicagoland is doing 11.4 million in average unit volume. The areas outside of that, 5.8 million. That's about half, not great. And then in the Sun Belt, 6.8 million. So what are they doing to improve that? Obviously, they have to increase brand awareness in those areas and brand awareness in the Sun Belt areas. And really, they're focusing on site selection and better site selection. In Chicagoland, they can kind of show you that they can open behind a mall, difficult to access with poor highway visibility, and still bang out a ton of average unit volume. In non-Chicago markets, they have to have great co-tenancy, great visibility, and great access to really get those average unit volumes up above where their averages are for the entire business. And also, they're revamping the concept for their growth in the future. In the past, they were building these 11,000 square foot behemoths, but if they want to grow faster and more, they're starting to focus on restaurants that are 7,000 to 8,000 square feet in 2023. And in the future, they envision this concept as more of a 55 to 6,000 square foot restaurant restaurant, which is again still double the size of something like the Chipotle, but it allows them to maintain the average unit volume that they have, gives them more visibility and availability of sites out there, costs less to build out, and also makes for more efficient labor and lower labor costs as well. And because of this, because of these changes, because of these smaller restaurants, they're kind of targeting better restaurant growth in the future. In 2024, they're going to grow about 10% in terms of restaurant unit growth on top of the same restaurant sales that they're going to see. And then in 25 and 26 onward, they're probably going to grow at 12% plus as they focus on new markets, as they move into new markets, as they develop those smaller restaurants, they can develop those faster. So they have a kind of a long-term growth algorithm of about 12 to 15% growth, with revenue growth in the mid-teens and then adjusted EBITDA growth in the low teens. So that's kind of the story here. There are 84 restaurants at IPO. They thought they could be at about 600 restaurants now because of the smaller formats, because of formats that might focus on pickup or walk-ups, takeout, etc. They think they can reach about 920 restaurants at full scale, and that's only in the United States. You can kind of see where they are, where they could be, a lot of opportunity for growth. So that's the idea behind Portillo's. The thesis behind investing in it is the valuation is really out of whack with the rest of the quick service restaurant market. I've kind of put the big players here, the kind of comparable players. You've got the more mature players in Yum and QSR and Wendy's, and then you've got the growing players like Shack, SG, CMG, Cava, Wingstop, etc. And Portillo's is getting a 2x enterprise value over sales multiple based on the next 12 months of sales. Everybody else is at 3.3x or higher. Why is the disconnect there? Well, I think it's because of the way this IPO was structured and some question marks around that. Maybe it's because of Portillo's not being kind of in the healthy sphere that's on vogue these days. But really, I think it's because the market might be mispricing this when you look out 10 to 20 years ahead of time. And again, this is not investment advice. These are just my thoughts. I'm using sales as a comparison because most of these companies are not profitable yet, or if they are, they're still very much in their growth phase. But if you look at Portillo's, they are actually GAAP EPS profitable. They have positive net income margins. They are not free cash flow margin positive in 2023, but that's because they're investing all of their operating cash flow into new restaurant openings. So that's kind of a good thing. That's kind of going to be the case in the future. But if they weren't opening restaurants, their free cash flow margins would be in that 7 to 8% range on existing restaurants. So that's pretty good already. If you look at these more mature companies, you can kind of see that most of them kind of settle in that low to mid teens free cash flow margins. So that's kind of a thing to keep an eye out for, 5 to 10 years from now. And if you look at, just some comparisons, Wendy's is trading at a multiple that's 60% higher than Portillo's. Shake Shack is trading at a multiple that's 80% higher than Portillo's. And again, maybe it should get a slightly higher multiple. It's growing a bit faster at 14% versus 12%, but should it really be getting an 80% higher multiple than Portillo's, or is Portillo's underpriced? And if it is, why is it underpriced? Well, one of the reasons is that when this thing IPO'd, the organizational structure is too complicated. I mean, look at this thing. Completely whack. This thing IPO'd under an UPSI, or an umbrella partnership corporation, and it basically allows investors in an LLC that is treated as a partnership to maintain the tax efficiency that comes with that partnership model when they IPO. So often those investors, these continuing pre-IPO members, they'll retain Class B shares, which can eventually be liquidated for public shares on a 1-for-1 basis. Plus, on top of that, because they're allowing the public company to retain the tax efficiencies, they retain cash considerations equal to a portion, 85% in this case, of the cash tax saving realized by the public company, attributable to the units that the public company buys out from the pre-IPO shareholders. And this can allow those pre-IPO shareholders to kind of double dip on the cash and earnings distributions that they may get while they hold the company, but then also capturing tax benefits of something they don't own anymore after they get rid of it. So you can kind of read through this. I would encourage you to read through the IPO S1 because there's a lot of complexity here. There's some situations where this tax receivable agreement can be pushed forward, so they may have to pay out earlier than just when those tax savings are realized. But again, the TPA isn't a huge deal, the tax receivable agreement, rather TRA, because they have to realize those tax savings to actually pay them forward. And that is a good thing for the company. What is a kind of a big deal is that when this company did go public via IPO, they had a total of 35.8 million Class A common shares and 35.6 million of Class B common shares. Again, it's the public shareholders owning the Class A shares, the non-public, non-tradable, pre-IPO LLC members owning the Class B shares. And again, this is a weird structure in that as a public shareholders, you own Portillo's Inc., which owns shares in the LLC units of Portillo's Portillo's operating company, which manages the operating subsidiaries. So you're dependent on this OpCo paying out their earnings to Portillo's Inc., which then can be given to you. So it's kind of a weird structure in that sense. And so they started with 35.8 million Class A shares, 35.6 million Class B shares. And since then, the pre-IPO shareholders, mainly Berkshire Partners, again, why I hate private equity deals and them going IPO, them going public after being a private equity company beyond just the debt those companies take on. Those guys have sold their shares, and that's done through secondary offerings where Portillo's adds Class A common stocks via an offering, uses that money to buy those Class B shares and basically delete them. So while that is not dilutive because the number of overall shares stays the same, it does increase the float of public shares. In the case of Portillo's, they've gone from 35.8 million Class A shares to 61.5 million Class A shares. And they've gone from 35.6 million Class B shares to 11.5 million Class B shares. So there's still some Class B shares outstanding, which means that in the future, there will be another secondary offering in order to buy back more shares. And that is just going to increase the public float, which might put pressure on the price. They just did this offering February 28th, 2024. I think the price was $14.50. And when they did the offering, the price was pushed down because now there's more float going out into the market, and that's not really a good thing. This is not dilutive because those other shares still have an economic interest, etc. But it does increase the public float. So another thing that sucks when you go through an IPO process from a private equity company is that they raised $429.9 million at time of IPO, selling shares at $20. Now the stock is trading at something like $14. It was $13 when I bought it. And they used that money to, one, pay redeemable preferred units in full for $221 million, repay all the borrowings outstanding under a second lien credit agreement of $158 million, and then purchase LLC units of Class A common shares to delete those Class B shares that they issued of $57 million. So again, some of that money went towards paying down debt, but at the end of the day, most of that money went to fill the pockets of the private equity company, and that's continued to be the case with those secondary offerings. And on top of that, you've got this other non-current liability, which is a tax receivable agreement, which means that they'll probably get more money in the future when and if Portillo's realizes those tax benefits. On top of that, they have a decent amount of long-term debt for a company that's only $1 billion in market cap, some capital leases. So is it a huge surprise that this stock is down 65% over the last 2.5 years, down about $6 from its IPO price, but it's shot up after the IPO. However, if you read a lot of these things, if you kind of figured out how this company was structured, you'd be wary to get into an investment here at the time of IPO. But now that the number of Class B shares has climbed down to only 11 million, the amount of secondary offering that is out there is maybe going to increase the float by about 15% at most, instead of 50% at most at time of IPO. It's getting a bit more interesting in my mind, which is why I started a position, because the financials kind of make sense to me, and not just from this perspective, but also from the perspective of where they're going. You can kind of look at their estimates of about low teens growth, free cash flow kind of getting there in the future. And as I look at the financials here, again, video is purely for informational, educational, and entertainment purposes only. It is not investment advice. As I look at my valuation here, as I look at the ticker, Portillo's, when I look at the market cap here, I'm including the Class A and Class B shares because I want to account for the potential future dilution that's going to be there when they do another secondary offering. Again, not dilutive, I used the wrong word, potential increase in float. Some of the websites out there will have a market cap that's lower than this because they're not accounting for those Class B shares. Even Ticker, I think, has a market cap at 789 million because those Class B shares aren't accounted for in there. You've got a debt of 539 million, enterprise value of about 1.6 billion. This does not include the TRA liability, so keep that in mind. That is still out there, is going to impact their free cash flows in the future. And that TRA liability is pretty high. You're talking about $300 million as they accrue those tax benefits. They might have to pay out $10 to $15 to $20 million per year in the future because of that TRA liability. So there's nothing to sneeze at, nothing to forget about. And as I look at their future growth, I'm kind of penciling in 12 to 12.5% for the next couple of years. I think that growth can be there for 10 to 15 to 20 years as they grow out those units. When you think about them being at 84 units right now, going into 200 units plus as a mature company, that's going to take decades to play out. This is a decade-long investment. As I look at buybacks, I'm looking at a negative buyback because they've issued stock-based compensation in the form of 15 to 20 million a year for the last couple of years. I think that's going to continue. They're not going to have free cash flow to buy back shares because they're using all of their operating cash flow in the next couple of years to build out new restaurants. That may change in the future, but I think that's going to be the case for the next at least 5 to plus years. As I look at future free cash flow yields right now, it's obviously trading at a negative free cash flow yield because their free cash flow yield was negative in 2023. But I think it's going to get close to positive by 24, maybe even 25. They're going to be kind of on that zero range for a year or two, but then start to get some free cash flow positivity going in the future. I'm kind of playing out a 4 to 5% free cash flow yield. And that's probably conservative given, something that's going to grow at this rate, given the potential they have. And then I'm penciling in a target return of 15% because of the Class B shares that are out there, because of the TRA agreement. Usually I'll target 10%, but for something like this, I'll target 15%. If I target 10%, at 15%, I get a fair value of about $12.41. At 10%, I get a fair value of about $15.49 with a free cash flow margin of about 7% by 2028. Maybe that's a bit optimistic given that they're still probably going to be opening up a lot of stores and still potentially investing a lot of their operating cash flow in opening up those stores. But I'm trying to kind of get a more mature sense of what they're going to be. And if at maturity they're at 7%, that's probably a bit pessimistic of me. I think at maturity they can be in the low teens, which means this is going to be an even better value, but I'm just trying to make the spreadsheet work. So probably their free cash flow margin is actually going to be lower than 7% by 2028. But again, from a mature standpoint, I'm trying to target at least 7% by then to make the spreadsheet work. And with all this in mind, I get a weighted expected return based on these valuations of about 11.8%. So that's pretty solid. That's why I opened a position in this company. I feel like if you look at this from the perspective of, the crappy structure that you got at IPO, it's starting to wind down. You're maybe 1 or 2 years away from Portillo's Inc. owning 100% of the LLC shares, which is what you want. You don't want the future uncertainty of increased float through the secondary offering to buy back Class B shares. You still have this weird TRA liability that's going to be there that's not there in the majority of stocks, which makes the market look at this a bit differently. And you've got an expected return in the low teens. So if you're targeting something around there, today's price point is great. When I bought this, it was about, $13. I think my purchase price was $12.99. I'd certainly love to buy these shares at sub $13. The stock price seems to be going up, but I think I'll slowly tick up my position here, especially if it stays in that low to mid teens range. If you kind of think about a company like this, if you can hit 11% free cash flow margins as a mature company, which is what a lot of those other companies did, you're talking about a potential annualized return in the low 20s. And again, this would be something that takes years and years and years and potentially decades to play out, because the goal here isn't going to be, well, what's my free cash flow margins 5 years from now? Because 5 years from now, they're still probably opening 15 to 20 restaurants a year. They're growing, but they're far from that 900 mark that they're trying to hit. So what's the risk here? Well, the risk here is that the market loves growth and they're growing at a small clip here. Maybe they feel like the market feels like they should be opening up more restaurants. But also, with debt where it is today, I think it would be risky for them to just take on debt to open up more restaurants, even though those restaurants are free cash flowing right off the bat, basically. I think what they're doing is smart. They're using their own operating cash flow to grow. Maybe they're growing slower than the market would like, and that may mean that the growth thesis and the return thesis may take some time to play out. You've got this secondary offering overhang that's going to be there at all times, which means that until they issue those secondary shares to buy out all the Class B shares, that's going to continue to be the case. That's going to put pressure on the price. You've got this TRA liability that's out there that is going to be a potential overhang to their ability to generate free cash flow in the next 10 to 15 to 20 years, because that's a large liability that if they generate those tax savings, they're going to have to pay out to those pre-IPO shareholders, those former Class B shareholders. On top of that, you've got to move away from kind of the unhealthy food that they offer to the healthy food that they offer. You think about Chipotle doing well, Cava doing well. Is that the future? Is this the past? Are people going to move away from this food? I don't think so. I think people still like this type of food. That's shown by the growth in their restaurant concept. I think the other question mark is they're amazing in the Chicagoland area. Can they grow that average unit volume outside of the Chicagoland area? You're talking about 11 million average unit volume in the Chicagoland area, 5 to 7 million in those other markets that they opened in. Can they tick that up to 8 to 9 million? If they can, this is going to be an amazing investment. If that stays in that 5 to 6 million, their overall average unit volume is going to tick down as they open up more restaurants outside of Chicago. But it's still going to be interesting, especially if they can take that size of the restaurant that they have and still make that average unit volume of 5 to 6 to 7 million work in a 5,000 square foot restaurant. Because as I drove by a restaurant in Arizona, these guys were pretty packed, so it certainly seems like they're doing well even outside of Chicago, but we'll see if that's the case in their results. Again, this is going to be a investment that is going to take ages to play out. I'm not super aggressive in building out my position at the moment because I think I can build this out in the next year or 2 or 3 as they do another secondary offering, as they increase the float, as I get more clarity around this TRA and exactly what their payouts look like as they get more profitable, because it does require them to be profitable and actually take the benefit of the tax efficiencies from the TRA agreement to actually make payouts, and they still only make 85% of those payouts. So a lot of things to keep in mind, but that's my thesis for Portillo's. Let me know what you think. Are you interested in Portillo's? Do you think this is a good investment? Do you think the valuation here is fair? Are there any things that I'm missing that is causing the valuation to be so much lower than all of the other quick service restaurants players in this space, especially ones that are growing as fast as Portillo's and have the potential to grow as much as Portillo's? So let me know what you think about Portillo's. Let me know what you think about the video. Like, subscribe, all of that good stuff. I'll be back with more videos now that I'm back from vacation, but let me know what you think. Thanks and bye.